Next up is another superstar in tax resolution and tax planning, also a trusted advisor, educator, and advocate for professionals across our industry. Angie Toney is a friend, a CPA, a PFS, the CEO of Oasis Tax Advisory Services, Inc. She has over 30 years of experience in corporate internal audit. Whew. She also leads Angel Financial Services, a thriving finance community and continuing education provider that empowers tax professionals through high value resources, training, and one on one mentorship. And yes, Angie, we probably should have used you for CPE today, maybe next time. She's also a highly valued member of our TaxPlanIQ Advisory Council and will be joining us again later today as part of the final expert panel to close out the summit. So please help me welcome a true leader and difference maker in this world of tax, Angie Toney.
Hey, thank you, thank you, thank you. Thank you, Jackie. I hope everybody is doing well today, and I hope I can keep it exciting too. I hope you hear me clearly because I know sometimes technology. I really appreciate you guys hanging out this afternoon. Let's see if we can get this tax planning going. You guys are hearing all of this, and all I hear is, oh, it's so expensive. I don't know. And this. You're here because you want to make a change in your practice. So now is the time. Let me get ready to share my screen. Let's not waste time. Let's just jump into it. I'm going to do the slideshow thing. Here we go. Come on. Hopefully you're seeing that. Go away. Put these on my calendar. Guys, I know about you. You have your EA, your CPA, your JD, or some of you are not credentialed but have tons and tons of experience, and you just can't make that move. You have this whole imposter syndrome thing built up about yourself. But we are going to show you how to get there. We were all there. Hey, listen, I started somewhere too, and I was like, I don't know if I can do this. I was locked up in a corporate prison mentality that I had to break out to say what I could actually do my own practice, close my own tax planning cases, and move on. And guess what? Solve problems. Guess what? Huge tax bills for clients, reduce their liability legally. Nobody's going to jail. And not make myself crazy with a whole bunch of volume work in tax preparation. I just can't with that. So let's see what we can do. As I said, was introduced, I'm a CPA, PFS, been over 30 years in corporate. And I was a certified fraud examiner. White collar crime was my thing. So ethics, compliance are everything to me. So we're not going to create fake strategies and all these things. And we're not chasing money here, guys. We are in a mission to really solve tax issues for people. Minimize liability as to close to zero as possible legally without stressing ourselves out, as I said. So let's see what we can do. We're going to talk about, everybody's already touched on this, we're going to be proactive and not reactive. We are cash basis calendar year taxpayers. That means January 1st to December 31st is our opportunity to do stuff. All right. Once 12/31 comes, a lot of times pencils down for a lot of strategies, but there are some that if we file an extension, we can carry on till, sometimes the April 15th deadline, sometimes the October. So let's see if we could touch on some of those. But be proactive. Don't collect all these theories that we're telling you. Gonna do something when you get off this call. I should have put homework first. I always put homework first because when you leave this call, you are going to close the deal and not dilly-dally on getting your tax plan IQ. I've tried many, many tools, and I promise you I'm not getting paid for it to tell you that I love TaxPlanIQ because it allows me to do tax plans that I believe in, that I feel comfortable delivering to my clients. My clients understand them. They're not they're not going to bog you down on, well, what is this really like. You can believe the results you're seeing in the tool. Okay, you're going to be an advisor and stop giving away answers for free. picking your brain for free, doing a tax return and telling them, oh, why don't you do this and why don't you do that? No, why don't you get on my calendar and I'll tell you about my other services that I provide. And then guess what? You're going to be a superhero. Those people are going to be walking billboards for your practice because you delivered, you showed them how to save money, okay, legally, and they're going to understand. You're going to help them implement if you need to. That costs extra, of course. And now you're going to see how your firm is moving along. You actually have a purpose here, and you deserve to grow your firm and not be bogged down just by volume if you really want it. Okay. Overview of our agenda here. Let's say we're going to talk about HSA, Augusta rule, accountable plan, hiring your kids, entity selection, retirement strategies, and some alternative. You don't have to give every client every single strategy. There's literally a periodic table of strategies that don't feel that, oh my God, I missed this, I didn't give them that. No, you're going to pick your handful of strategies, customize to the client, and deliver something that they paid for. And you're going to feel very comfortable because guess what? We have that ROI tool that's going to show you and wow the client that, listen, even though you paid me X, look how much I saved you. And over 10 years, if you use the same strategies over and over again, your plan pays you back over the years. If you're a business owner, it's tax deductible. So we're going to show them all of those things, the impact in the ROI, right? And then the next steps. So you may need a team. You see how earlier Anton talked about financial advisors and this, you're going to have a team. You may have an attorney you can go to. You have your subject matter experts. You don't have to know everything. Frankly, guys, when I started with TaxPlanIQ, the people, the customer service is so excellent that if you're confused and lost, you have a place to go. I think what holds up a lot of practitioners from getting into something, it's about fear. Oh my God, I'm going to make a mistake. They're going to sue me. This thing didn't work or whatever. So we want you to get comfortable in what you're advising your clients. You can do this. You absolutely can do this. And 3 or 4 tax plans can pay for your annual. One tax plan can pay for your annual subscription, right? But let's get you 3 or 4 if you're afraid of the pricing until you get comfortable. I'm going to admit it. I'm bad at pricing. I know Jackie always tells me, Angie, you got to charge more. You could charge it. Don't get hung up on the money yet. That's a skill that you get with experience. So yes, I'm gonna do better. We're all doing better here. Okay. Why do you want to plan? This is where you're going to educate your client. You ever get these clients like they cry about extensions? Why did you give me and they complain, complain, complain? It's about education. You have to educate your client in what is a tax savings versus a tax preparation. Tax prep, a return is a historical document. Okay. You want to do preparation is compliance, but when you're proactive, you're planning. When they start crying about that bottom line, well, see, I told you to get on my calendar. I have savings opportunities for you. You have to be proactive, get on my calendar, and I'm going to show you my other service that I offer you. I see that you're overpaying taxes. Good trick that I had whenever I was at the end of a tax preparation engagement, I would say, oh my God, this client sure paid a lot of tax. And I'm not just talking about tax due, I'm talking about the line that says total tax, the amount of tax these people had to pay, not counting estimates and withholding on the amount of tax. Right. So what I'm saying is when I review that tax return, sometimes I do a 5-minute video. That's my opportunity to plant a seed and say, listen, I'm reviewing this tax return and I see where you can lower your income. Oh, shoot, did you know that you can do this? And you're planting a seed in that video because you're going to come across passionate. They're going to see your passion. They're going to see your knowledge. They're going to see that you care. And that's your selling point to these clients that you feel like you can't close a tax plan engagement. So let's get over the shyness. This is a people business. Okay. I don't want to hear, well, I don't know. I can't. You're not selling. you're sharing. And frankly, you're selfish if you're not telling these people that you can do this, you can save on your taxes. This is what I know, this is what I've studied. And then there you go. And now when you're part of a community, you can double check your answers if you're that afraid. Okay. So again, somebody else had said, prior speaker said, you're not in business by yourself. You're collaborative and you have other people you guys can do, two people can join on a case together and everybody gets paid, clients get served, everybody's happy. Okay. So finding the clients, start with your current client list. This is your homework. You're going to go through your tax uh, book of business that happened in the last season and look for the ones that ended with a huge liability, right? Forget about the withholdings and estimates, as I said, just look at that line and then feel sorry for that client and say, oh my goodness, look at how much you paid in tax. And I bet you they're going to be all ears. All right. Also, you got to show up, go to speaking events, become, oh, right up, check this out. I have to share this. I know I'm kind of all over the place, but this week I had a prospect on my calendar and I asked him how he found me. He said artificial intelligence. He went in and specifically asked for somebody, a practitioner in his area, whatever his parameters were. Sometimes they're looking for, a person of color because they want to support that business or somebody who they can relate to or whatever. And an article that I was quoted in Nerd Wallet 2 years ago came up and he loved it. Then he goes to my YouTube channel. He sees what I'm all about, and we matched. And he says, "This is the practitioner I want." It works. You have to show up like an expert, like you know what you're talking about, and you do know what you're talking about, right? But nobody else knows it if you keep it to yourself. So you got to be out there showing how great you are. And guess what? They do not have to own a business to need a strategy. We have very wealthy people. And what about you? Did you even do yourself? That's the thing. You should be your first client because what you're going to do is advocate for your client based on things you know. And what if you're not even trying strategies for yourself? Put your name in the TaxPlanIQ software and try to see, well, if it were me, I would do this. A lot of times I start with my clients, I said, there's no right or wrong answer. There are just a bunch of options. My job is to advise you if you did this, if you did that, there's no right or wrong, as I said. Let them choose. Don't tell them what to do because that already is putting you in a liability risk. You need to be able to say, here's your smorgasbord. Like you're going to show them all of the strategies that you feel fit them and let them choose. Okay. Now, how are we going to find the strategies? Let's say we found the clients. How are we going to find the strategies? Well, the return is going to talk to you, and I'll drop a link in the chat. I don't know if I have access to the chat right now. Let's see. I have a YouTube video on a S corp that I had analyzed. Let's see here. Chat.
I can help you out as well if needed.
Oh, that's so sweet. I happen to get it. So
Okay.
that tax return talked to me. It's about 20 minutes, so don't do it now. You need to be listening to me right now. But you're going to watch that video and you're going to see how I had this client who's an S Corp election entity and the individual. So I walked through the S Corp and then I walked through the individual return. And I was like, what? The prior practitioner made so many errors. I saved that client $100,000 easily without a single strategy. Because part of what you should be doing is looking for compliance issues as well. And that will get you started. And now you're teaching yourself how to read tax returns as you already know this, you're just not paying attention. As you're putting a tax return together or even reviewing, if you're on the reviewing end, you should let each line of that tax return talk to you, right? We're trying to do three things: reduce income legally. Hey, did they miss any expenses? Should we have reimbursed that? Are there benefits? I have a client, CSE reasonable comp. I have a client paying herself over $300,000 in her S corp, and I'm like, what? What? And her practitioner is not even telling her. She has like almost $500,000. I'm not making this up. $500,000 in basis. Every year she's adding to basis and not taking her tax-free distributions, instead paying herself this exorbitant amount of salary and paying FICA. Just the tax benefit alone, I charged I charged her for the tax plan, and she made that back up in two pay periods, right? Because the fight, she's overpaying. Mind you, yes, Social Security has a limit, but Medicare has no limit, right? And you're paying additional Medicare. There's a whole bunch of other reasons too why you want to pay yourself the right amount. So the first thing we want to do is reduce income legally. We want to increase deductions, right? So mostly adjusting to income, especially if you're self-employed. What are we missing here? You should be going through that schedule one and all the schedules to see, hey, is there any extra taxes that I can remove? Are there any extra adjustments I can take? And so on and so forth, so to make sure that you didn't miss anything. Ask yourself the question, why is this here? You know how I catch myself too, like sometimes some people, when they do the HSA distribution, they forgot to check the box that says it's not taxable because it was for qualified medical, something simple like that. So when you review yourself, make sure you look at what the NIIT, that poses a lot of reasons to catch error. For example, I catch S Corp, and this was in the video one that I'm telling you to look at. The one in the video that I just put in the YouTube, the practitioner marked them as not materially participating, and that's going to cause an NIIT. So you got to look at these things, these errors that are causing these taxpayers to pay more. So it's not just about learning a bunch of strategies. You have to be on top of your tax game. You have to be taking your CEs, CPEs. You have to be collaborating with intelligent tax pros who are doing the right thing and interested in producing quality work. Quality first. Quality first. The money will follow. The people will follow. They're going to say, oh, you got to talk to this pro because this pro did this for me. Look at this ROI that this tax pro gave me. And the pipeline, you're going to be like, oh my God, I'm going to smack Angie. I can't turn off this pipeline. Too many cases. And so then you're going to have to start saying no or grow your business and hire people and so on. And then the third thing we want to do is increase credits. I know I talk a lot, right? Increase credits, any credits that can be taken, particularly if we lower the AGI. So some of them, right, phase out of their child tax credit, their American Opportunity Credit. But if you lower the income legally because of some of the other strategies, then these credits kick in, then other credits kick in. So those are the three things mainly that you should be asking yourself as you review a tax return for strategies. Now let's jump into some of them. This slide is really supposed to show you how to click in and get to that YouTube video I just put in the link. Let's talk about an HSA. Who's good for HSA? Individuals, right? It's not complicated. We pretty much know what they are. Every time I see a client in an FSA, I'm like, not an FSA. The HSA, the FSA, if you don't use it, you lose it. Nonsense. The HSA carries forward. There's a higher limit for you to put in, for the client to put in. It's not great for clients who are ill and have a lot of accident. Like I have a client with 3 children on sports teams, broken arms, teeth fell out, all kinds of stuff. And I'm like, you should not be in an HSA. You more need a higher premium. So like a higher plan with not high deductible. Because you're going to come out of your pocket a whole lot and eat up the HSA anyway. It's not doing any good. However, if they have a business, now you're talking. I've seen clients, if you look at a Schedule A, you'll see medical expenses and a big fat zero, right? Because 7.5% of the AGI, they can't beat it. So what do? I say, oh, honey, no, you need to be in an HRA. Okay, health reimbursement arrangement. I don't think I covered that in this, but now that's something that is going to tie into hiring your spouse or blah blah blah, and we can lead out. See, I can go down a rabbit hole in all of this. Oh, sorry. Let me just see somebody's way. Is there a strategy to find clients who went to bad preparers in the past? I love clients that come in from bad preparers but don't know a consistent way to find them. Well, what I had described before, meaning deliver, because clients are always looking to change. So you have to, sometimes they feel like they're missing something. My practitioner is great, but he doesn't advise. And they're always crying and complaining and this and that. But guess what? If you deliver, as I said, to the ones you do have, they're going to tell other people, because people are going to go to them and say, well, who do you use? And then they're going to find you. I promise you, there's so many people out there looking for strategists, but they're not going to find you if you're a secret. So you got a perfectly great presentation earlier on marketing and emailing the right people. You're going to find them because people are going to hop, skip, and jump looking for practitioners, but they're not going to find you if you're not out there in the public. All right. So again, HSA, I think there's some slides on HSA. So cannot be covered by another non-HDHP. You're going to look at the rules, see publication 969. So you cannot be enrolled in Medicare, right? So a lot of clients, when they get to 65, they get on their Medicare. There's some that are not. So, but once you're in Medicare, you cannot contribute to an HSA. But I have clients who are young, and I'm like, oh my God, every year this is money that is tax free, goes in tax free, grows tax free, and when you use it for qualified medical expenses later in life, tax free. This is money that's virtually never taxed. Why are we not all in this? Other than the ones that I said before who are unhealthy, it's not the best for them. But we can think of plenty of other things for them. So we need to be here just to let you know, when you get to 55, right? The taxpayer gets 1,000 catch up. The spouse, though, when the spouse gets to 55, has to open his or her own HSA, because it's just like the 401k under the Social Security number. So you have to open your own account and dump your $1,000 in there. You should be maxing this out. All right. Client has a high deductible health plan we talked about. It cannot be independent of another person's return and doesn't have HSA or isn't contributing the maximum amount each year. All right, so you have to focus on the rules to make sure you're not breaking the rules and that you can do it. Hey, you can self-direct it. Heck yeah, you can have rent or real estate in your ages. Because the idea is, once it hits a certain number, you're going to invest it and then it grows, right? That's what we ultimately want. It can be used for Medicare premiums, long-term care premiums, long-term care health stuff. Anything the doctor says you need that's not covered by insurance, go back and look at the publication on medical expenses. HSA, so it's a triple tax benefit we talked about, how it grows, contributed as much towards the max. Now you can only, if you're an employee, like your client is an employee, they can only elect it during open enrollment. Right? Your other clients who are business people, they may be able to open one outside at a bank or whatever when they start implementing their healthcare situation. Just kind of look at the rules. There are rules if you have both an HRA and an HSA. My favorite newsletter out there, Bradford Institute. He does mention that you have to reach the deductible in your HSA first, and then you leave the HSA alone, and then you transfer over to your HRA so that you can get what? You get deduction for your business and money out to reimburse you on your medical costs. And it'll lower your FICA, right? Because you're lowering the profit um, on your business. So I need you to follow the rules there. Ask your insurance provider, right? What kind of plan do I have? Can I do this? You cannot extend to October. So if you missed it already, April 15th is gone. Consider it for your clients for the next tax year. When open enrollment comes around, boom, open it up and then fund it. So it's unlike the FSA where you could use the FSA before the money is in there. The HSA is sort of like a bank account. The money has to be there to spend. You can reimburse yourself later on, though. Once you put the money in, you can go back and reimburse yourself. But you have to have the HSA open. That was the trick. All right. Grow the funds tax free. 8.5K into an HSA per year saves you 2K at least, right? On average in taxes, then grows another 500 depending on your investment strategy. So that's good. Be careful not to double dip, right? You cannot say HSA and then the HRA and then, you're getting reimbursed by the regular insurance or whatever. So follow the rules there. We talked about HSA versus versus FSA. And if you distribute HSA funds for non-qualified medical expenses, that amount is considered taxable income. So I had a client like that, 8,500 in, 8,500 out. I'm like, dude, what are you doing? No, you're missing the concept. And this is where, again, proactive. Hey, my kid is going to need braces, or I want to do X, Y, Z. I believe fertility treatment is even covered. So you have to look at what your needs are. This is how this is going to work in conjunction, right, with your HRA setup. You want to make sure that the spouse, if you hire the spouse, is doing work commensurate with whatever that amount is that you need to pay for something, and you either reimburse them out. If you don't finish with the HSA, you can do the HRA, and those kind of work together. I know that's kind of confusing. I said a lot. I'm trying to tell you a lot of stuff. So you can get on our calendar and ask more questions later. We're on the panel later if you need me to clarify some of that stuff. All right. So be careful of planning. I'm not going to go through this crazy HSA flow chart here, but pretty much it's just asking yourself questions and deciding whether it's going to end up in the taxable bucket or be tax free. Okay. We like tax free. Augusta rule. Hey, you actually don't have to only be a business, because this is an individual strategy. But let's talk about the individual side. This is for people who have a dwelling, meaning it has to have a bathroom and a kitchen, like you actually live there. If I lived near Yankee Stadium and there's a World Series going on, I could virtually leave my home for 14 days or fewer and rent the place to somebody. Yeah, let's say $1,000 a night, tax free. That's an individual. So you can use your regular home and rent it to somebody for 14 days or fewer, tax free. On a business side, we want to say, hey, let's, oh God, yes, the Olympics coming up, World Cup. You guys got to be smart. What's in your area? What's your client next to? What's going on in there? Festival, whatever. Try to figure out ways. But who better to rent to than your own business? Isn't that great? That's where the Augusta rule. But guess what? Lots of rules here. So don't evade taxes. Avoidance is legal. So how can we avoid some tax here? Well, this is where we are. Let's say in my dining space, I'm going to have my board meeting, right? Be it a board of advisors or board or shareholder board meeting, and I'm going to get quotes from the local area. Let's go into the slides. 1231. So it's an expense within the calendar year. That's why that's there. So you own a home that can be used for business purposes for less than 15 days. So as I said, 14 days or fewer, the home cannot be considered a full-time rental property. As soon as you hit 15 days, you got to put on a Schedule E, honey. So don't make that mistake. You ever see clients come in and they're paying themselves rent for, it's so crazy. And I see it on the Schedule E. I'm like, what are you doing? All you did was shift over the income. It's so silly. Well, whatever. We're not going to get into that, but people do it. It's applicable to S corps and C corps. Now you're going to hear and partnerships, but you're going to hear some practitioners say, well, single member LLC, you're considered the same, but I beg to differ. And that's just my opinion. You have a registered entity here, a structure. I know it's disregarded to the IRS, but you can make an argument that you have to have your annual board of advisors meeting. So don't do it if you don't feel comfortable doing it, but I'll do it. I feel like I have to have a board of advisor meter, and instead of me go renting a Regis office space, I'm going to have it right in my basement, or I'm going to have it in my dining room, not in my home office. That's a completely different strategy, guys. So don't mix it all up. Augusta rule is completely separate. So you want to be careful here and making sure that we're keeping minutes, because minutes are, listen, documentation is everything. The IRS wants to see that you're running a business, not a business. All right, a real business with a rental. You can do a written rental agreement. Meetings must be documented with notes. What did you discuss? We're not talking about essays here. We're talking about bullet points. Just say blah, blah, blah. So and so met, there are templates out there of meeting minutes. So you should have those. thorough documentation supporting the rental price. We advise at least 3 quotes. You can go to the local Hilton, you can go to that restaurant space over there, that Regis, get 3 quotes in your files for the client. And then it'll be like, oh, $600 a month to rent this space or whatever. And then you can put that in. And then now you can charge Angie, so if it's my business, I'm going to charge Angie, the individual, $600. And then I can take that deduction from my business, tax-free money into my individual bank account. Get it? Yes, we love this. So this is how I probably talked through this already. It allows you up to 14 days. The IRS, if you go to the IRS website and Google short-term rental and scroll down, you'll see it on that page that tells you and now guess what? A lot of practitioners argue this too. Do I have to issue a 1099? You, in my opinion, do not have to issue a 1099. It specifically says that on the IRS website. This is because I'm an individual Joe Schmo. I'm not running a business. I just have a house and I'm saying you can use it for 14 days. You do not have to issue me a 1099 because it's not a reportable income anyway. You understand? On the business side, you want to document the invoice perhaps because it's a business. Okay, and you want to have that. This is why I paid $600 to Angie, because I had a meeting, blah blah blah, and this is giving you some options too of where you can get quotes, movie theaters, private conference spaces. The rental rate does not include the business meals. That's a separate deduction. Yay! And there's no minimum participant requirement. It can be 2 people, right? So you guys look into these rules and making sure that you're documented properly. Document. That's what the IRS likes to see. If you rent your home for more than 14 days, you just killed it. All right, we talked about that. Accountable plan. Oh my God, how many times have I seen clients with their S corp election? The practitioner elected the S corp and they're not doing an accountable plan, but sometimes they do write off their home office, their personal mileage. This is incorrect. And when you're doing a tax plan, you better believe you should, at least I would consider you valuable if you tell me about an accountable plan. And this is not just for an S corp. This is for C corporations as well. You should have an accountable plan documented, right? Where people are going to submit. Do you remember we working for corporate? Some of you worked for corporate and travel for corporate. They have a travel and entertainment expense policy. That's what an accountable plan is. And you're going to have a template of how you're going to submit to your business so that you can get the reimbursement. And you're going to say, well, you can do it. Now, the IRS has a rule within 60 days. If you spend the money on the behalf of the company, you have to submit within 60 days. You can argue that, for example, home office, you can say, well, shoot, I got to do the mortgage and I got to do the utilities, and I don't really know the amount until the end of the year when I do my 8829. You can do that. And then, but you can also just estimate every month, and in the last month, just true up, right? And so the client can have an easy way of taking money out of the company monthly. So it's a flow. We have a template. We do have a template. We could talk about it. Actually, Intuit has one. It has the policy. You can Google it. I'm sure they're there. There's the creative accountant. She has one. There's several places. As you mentioned at the beginning, I do have a training platform called the Executive Touch. We have templates in there as well. We talk about this stuff all the time. So for C Corps and S Corps, you have employees. Do any employees of a company have unreimbursed business expenses? You should be looking for that. And if they're taking it without an accountable plan, you need to fix it. Business owner has unreimbursed home office expenses and qualifies, right? So sometimes a partnership has employees they want to reimburse. You should have an accountable plan. It's not necessarily for the owners, because obviously there are ways for the partners and the sole prop or the single member LLC to get the money out. You just do your 8829. But when you're reimbursing employees, you need an accountable plan. Yay, see, Jackie Meyer has one, and TaxPlanIQ. Let's go. We cover everything. Now, so you allow the employees, in this case, owner employees, to be reimbursed. The expenses become deductions, right? And you can be reimbursed. So reimbursements are not taxable. That's the part you don't want to miss. Like you newbies out there doing strategy work, that's why this is a strategy, right? It's how you get money out of a corporation, generally speaking, that's not taxable. In order for this plan to be qualified accountable plan, it must have what? A business connection, which means a purpose. Substantiation, expense reports, receipts, receipts, receipts. I've been in plenty of audits with the IRS and they care about receipts. They're kind of, I hate to use this word, stupid, but sometimes it's very stupid because they're just like checking a box and doing things that really, if you give them a statement, they say, oh no, a statement, I don't know if that's personal. And they really get really icky with that. So you want to get a receipt. But anybody gonna get a receipt and write on it, right? Write whatever you want. But receipts are really the best substantiation in combination with notes and things that you do. If you're going to have a business trip, flyers are good. Calendar, use your calendar. Tell your clients, using, I'm saying you, but you know what I mean, your clients, right? No excess payments, timeliness, the 60-day rule, as I mentioned. If not dispersed under the accountable plan, the payments to the employees could be considered additional wages and they'll tax it. So it can be done. So mileage, auto, home office, travel, meals and entertainment, bunch of stuff. Anything you use on your personal side on behalf of the business is considered a reasonable expense that can be deducted. You just have to have the business purpose. Is cheesecake deductible? Generally, no. But if I served it at a event, you better believe it's 100% deductible, and you need to reimburse me if I have the event on behalf of my business. Funds must be deducted from the business account within the year. Calendar year taxpayers. Got it? Got it. So, so for sole props, I would, kind of, you don't really need that unless you have employees, right? For corporations, the accounting plan is not implemented. All the payments of unreimbursed business expenses to employees must be included in gross taxable wages. That's even if they drive the company car, guys. So you guys have to pay attention to the rules. It's very strict. Make sure you're diligently following the guidelines. Must state the reimbursements are allowable. That's what the policy says. So Intuit has a nice policy you can use. A lot of people use it. I would still check with my attorney to look at your policies. You guys, if you're running a real business, you should have like a tax, sorry, a legal buddy. I don't know what's on my throat. Sorry, a legal buddy that you can bounce things off, or make sure you have an attorney source that you can check some of these policies off, right? Including for your state. Here's the flow chart. You're going to get the slide anyway, so I don't have to read it to you, but here it is on following whether the accountable plan works, how you do it. We want to be tax-free. That's the point. Here's some example. Here's the one that I always see from the Intuit sample accountable plan. Fill it out, put it in your meeting minutes. Hey, better yet, have it in your dining room, discuss this, accept it, and now you got a business deduction for not just the things on the accountable plan expense reimbursement form, but the Augusta rules. See how they work together? Nice, nice. Hiring children. Now, I know we touched on this earlier. If you have a business, by the way, you can Google IRS Family Help. There's a nice summary there on how to treat different people in your family that you hire. So not just your children, but your parents, their rules. I had a client who wanted to hire their parents when they were new to the country, trying to get FICA for them. They want to hire them as nannies or whatever. You cannot hire parents as household employees to get FICA. You cannot do that, right? So this guy had a business. I'm like, dude, you have an IT business. Let your parents do something in the business and really earn the money so they can get their 40 quarters or 10 years so that they can qualify for Social Security. So let's talk about children, though. That's where we are. Karen, right? 1231. So you got to pay them by 1231. How are we going to do that? Well, if you have children, right? Your business owner has children, or family members they support. So they're dependent on your tax return. So cases in court had at least age 7 that you can argue can be paid and get this deduction. Now, mind you, these children, if you're younger than that, I've seen babies, right, as models on websites and things like that. So, apply it at your own risk. But I'm just saying, you should. My by the way, all these strategies we always talk about the IRS. What about the state? You got to look at your Department of Labor rules for your client. What can we do in Maryland? What can we do in New York? What can we do in Texas? What are the rules in your state, when you hire people, right? Young people in your business. Because you don't want to have them mining for coal at midnight or anything, right? Or missing school and whatever. So there are rules on working papers, things like that you want to follow. Most states, if not all, really allow you to hire your children who are your dependents, as long as you're not breaking any Department of Labor laws. If you pay them standard deduction or below, no FICA. They don't have to file, so no federal and or state taxes if they're an income tax state. So you still get to claim them as a dependent. Isn't this brilliant? Come on, this IRS loves you. Yeah, right. But that's one of the ones that can be good. Children are able to perform business tasks, so it has to be a legitimate task. They can clean the office, they can supply the office. So meaning office supply organization, like they kind of unpack the boxes and things like this. But guess what? I have events and my kids come. They meet and greet. They have people sign up in the sheets, and my son is now 18, so there you go on my child tax credit. So now he has to actually learn to file a tax return. I get him entering W-2s. I have him now, he's going to learn some bookkeeping. As they get older, you can raise up what they can do. My son has a brilliant personality. He can do YouTube videos. So my daughter, when she was 10, I had her read a script into YouTube about hiring family members. And it was 3 or 4 minutes. I paid her $400 to do it. And let me tell you, it got me clients. So again, it also shows your expertise, that hey, this is how I'm implementing this strategy. People are going to see it. They're going to say, oh shoot, this tax pro knows what she's doing. They're not going to just get their information from TikTok. They got it from you, a qualified, knowledgeable, skillful professional. All right. So there's marketing, social media. You're limited by your imagination. And what can your kids do if your tax client has rental property? There are other things there. I have a whole list of things that kids can do, as long as it's legitimate and you have a price, like how you would pay an arm's length teenager down the block to do it. You should really do it like that. Mhm. So legitimate tasks, think outside the box. What else? What's the reasonable amount? The work must actually be done and related to the business, and the child must be capable of doing it, right? So that's good. My kids hate shredding. But I'm gonna tell you this. I'm not gonna lie, it's hard to get children to work sometimes, but I'm gonna tell you this, the younger you start, the better it is. Because now they're getting into a habit, and they recognize money doesn't grow on trees. And if you want that new Mac, you have to do XYZ. It has to be quality, and so on and so forth. So I'm gonna try this new strategy. As I mentioned, my son is 18, getting ready to go to college. He did get some scholarship, but I'm like you. I'm student loan averse. And so let's see how this is work. I can literally pay him $20,000 per tax season very easily. And I feel I need him to work in my practice and put that money aside. We're going to decide where we're going to invest it. And now it's going to go towards his tuition. What did I just do? Guys, even though he's 18 and he has to pay the FICA, no problem. He starts to 40. He already does pizza, the mod pizza, and he works for Top Golf or whatever. And he does all these other things, and that could be his mad money. But the money he works for me is going to go towards his IUL, let's say, and build his cash value. And it's going to go towards his tuition. Let's see how we do. Circle back with me every year and see, well, Angie, how you doing on them student loans? Because I hate student loans. I have clients with $350,000 between the two of them, and in student loan debt and they're like in their 50s, pushing 60. They're never going to get rid of that debt ever. I have physicians like that. There's a couple of good Netflix documentary on it, or Amazon Prime, the real cost of education and things like that. There's a dentist in one of those where he's paying $7,000 a month on his student loan debt. We hate student loans. So if ever a place for you to sell, hi Dorothy, if you ever have clients with students, young people on their tax returns, you can't tell me you can't close this deal on a tax plan, honey. You got to tell them about the LERP. You got to tell them about hiring their kids, and really hit them in where the emotions are around that student loan. You can have a section 127 in the business. That's tuition reimbursement. So we know 5250, right? Anything above that, you can pay above that, but it just becomes taxable. So look at all these strategies around children, hiring them. Their reason, by the way, children have to be 21 years old. People have to be 21 years old to get Section 127. So just follow the rules. As I said, you can do this. You just follow the rules. Stick with the TaxPlanIQ team and any other mentoring training programs that you have, because you want to do this right. I don't know how am I doing on time. I talk too much. Let me keep moving. If the children have passive income over 1350, it will exceed their standard deduction. Pay attention. If you're ever audited, the IRS will want a time log. Timesheets are important. You don't have to have an employment agreement, but document the timesheet, have them document the newsletter or whatever it is they're doing for you. You're as good as your documentation and your argument. Just make it legitimate. Explain risks, red flags, blah, blah, blah. Don't be greedy. I always tell my clients, don't be greedy. You have a 7-year-old, you don't have to pay them $12,000. You can pay them $3,000, $2,000, $500, better than nothing, right? Don't be greedy. That's what happens when they get into trouble. Entity selection, love, 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 love this one. I don't know about you, but you know how many S Corp election people I see come in to my practice with, they way surpass the benefit of the S Corp election. Why are they so C Corp averse? This double taxation. I'm glad we had a speaker earlier talk about there's plenty of ways to get money out of a C corporation without declaring a dividend. We don't have to have double taxation. So make sure you're doing an entity optimization. Can you use section 127 for an employee who is a child of? Yes. So I learned this at the IRS tax forum. There's a in 2019, I went to that forum and there was a presentation on fringe benefits for S corporation. And it's the same rules for 2% or greater shareholder on section 127. Even the owners 5250, their kids can get the 5250. All right. So that's a good question. Again, rules, rules, rules. Do you have self-employed or business income and the ability to change to another entity? For example, changing from Schedule C to a partnership and having a spouse as a limited partner could save 50%. So whenever I have a husband and wife business, I'm just going to say this here, it's almost better to have one report to the other, especially if there's no real reason why they both have to be an owner. Sometimes you have big heads, I get it, but it's almost always better to have one employ the other. Why? Because you will overpay FICA. Hey, as a matter of fact, that YouTube video I gave you before, watch that one, because she's 100% shareholder. The spouse is hired. They were paying each other. They were paying themselves together over $300,000. And I'm like, dude, you can virtually hire the spouse and pay him in mostly tax-free benefits and save on your FICA. But that's a whole other thing that you can go down a whole road with that, but that's a good one. Alternatively, someone in the highest personal tax rate that does not take much, and I told you about that one. I have the client paying herself over $300,000 a year in an S corp. She's banking all of her basis for what reason, right? She clearly would be better as a C corporation. Plenty of benefits for her. Sole proprietorship, how it works, we already know. I don't have to tell you. You guys are smart people. You know about being a sole proprietor. You're not really an entity per se. You're just a person doing stuff. right? It's a business, don't get me wrong, but you have no protection. You can't elect S corp until you're at least an LLC, right? And everything is on that Schedule C. Schedule C filers are the most audited of all taxpayers. I do a lot of representation work as well. But that's why it's good to know this, because you know what happens if you do a lot of representation work. This could also be a funnel to your tax plan, because you're trying to save taxes before they got in trouble, a lot of your business owners. So these are great places to find clients as well. So I want you to look at this. A sole proprietor with net income will need to pay quarterly taxes, but I'm one that don't like giving more money to the IRS. So if I can find better things to do with my estimated taxes, you better believe I will do that. But it's a balancing act. I'm not telling you to not pay estimated tax. Oh, did I go too fast? Sorry. I passed that. I'm not telling them to not pay estimated taxes. I'm just saying be smart and balance. This is about partnerships. I hate partnerships. They're like the bane of my existence. A lot of clients are in partnerships that don't need to be in partnerships. Example, husband and wife with rental property ownership. They're multi-member LLCs. You can actually opt out of subchapter K, which governs partnerships, because you just want the asset protection. You're not an operating entity. So there are ways to do that. I just want to put that out there, because you have a lot of partnerships out there that do not need to be partnerships. I actually have a partnership where I don't understand what the second partner is doing. So I don't know why she's a partnership, but I'm just saying there's a lot of complexity in partnerships. I'm not going to go into all of this. You can read this yourself. I know I'm running out of time, so let me hurry up. S corps. I don't love S corps. I like them in the sense that it's a stepping stone, but again, people fall asleep and sometimes pass out in this S corp election status and don't recognize that, okay, honey, you've saved the FICA already. Let's move on, because they're not looking at the income tax. They're just looking at the FICA. And sometimes this S corp is not doing them any good. And especially with all the fringe benefit rules. I think I had a video out there where I talked about 10 reasons why I hate S corp. It, again, a stepping stone. And how, oh, yesterday we had a board meeting and we talked about how do you terminate an S corporation? And that's pretty interesting. So I'm not talking about revoking, I'm talking about terminating when you realize that, wait a minute, I would have paid less tax in a C corporation at a 21%. By the way, when you revoke an S corp, you're automatically a C corporation. No choice. So unless you do that 8832 to convert yourself back to an SMLLC or MMLLC, whatever it is you want to do. If you're already a C Corp, you're already a C Corp. That's fine. So you have to think about all the rules. What does my equity section look like? So when you're doing planning and strategy, I want you to think about everything. You should have a nice checklist. Okay, I'm going to terminate my S Corp status. I got to make sure my bookkeeping is right. What about my EIN? Does that affect my EIN? Who am I hiring? What are my benefits looking like? Blah, blah, blah. There's a whole bunch of things that you got to think about to yourself that you're not going to mess the client up by making this election. Okay. Yeah, lots of information. C corporation, how it works, advantages and disadvantages. I love them. To me, when I'm in business, eventually I want to be a C corporation, period, because it's the best asset protection. You don't have to worry about fringe benefit rules. It's a great way to exit your business. There's just lots and lots of advantages. Is it for everybody? No. And again, there's no right or wrong with these entity elections or selections, but there's also a combination. Maybe you need more. Maybe you need a C Corp and a SMLLC, right? Because you can have a family management company. It's almost always best to hire family members in a separate entity than where your other employees are, because maybe you want to give up a benefit that you don't want everybody to have, just the family, such as HRA, right? So you want to think about a combination of some of these entity selection. I once went to a training and the attorney presented the tax plan for Dustin Hoffman, the actor, and he had like a whole org chart of strategy, trust here, partnership here, and whatever. And it was very complicated because as the client grows and gets more wealthy, you're going to need more sophisticated structures. All right, keep it moving, Ange. Retirement strategies. We know about a lot of these. The IRS has a publication. It escapes me right now. Bunch of threes in it. 1330. I forget. I forget. But whatever. You can Google it. They have this whole chart, and you should always be looking at this. What's pre-tax benefit? Any client that I have paying themselves below 6 figures, I'm in a Roth. Period. I need them to not push the tax into the future. Everybody's pushing the tax into the future because they want the savings today. But sometimes when they get into their later life, right? They're empty nesters, their house is practically paid off, they have fewer deductions, and they're still in a 6 figure tax bracket. And now they're pulling out $100,000 out of their 401ks, etc., and paying a whole lot of tax. Balance, guys. Tax now, tax deferred, tax advantaged. That's why they need you, because you're going to advise, Miss, you need to be doing this or that and balancing out the tax act, right? So that you're not overpaying taxes in any one of these buckets. Life changes, you grow up, kids grow up, you retire, you work again, you do this. There's so many different places to this. So that's why, having a nice team to help you figure out traditional IRAs. You guys know what that is. By the way, partnering with advisors help you, because do you know all the rules on these retirement plans? No. That's why when you have your go-to advisor on your right arm or your left arm, whatever, you can always ask them, what are the rules again? What's the limit again? Because it changes every year and you don't have time for that. You have time to advise and stuff, but you don't have to know all the details. Someone talked about the defined benefit plan earlier. We love, love, love this. This is great, especially when you're in a C corporation. A great way to get money out for you, more for you, less for Uncle Sam. The SEP IRA. This one is great when you can push it off till with extension. So if we don't have the money today, you can plan and over the next few months put it away, put it away, put it away, and then sock it into your SEP before your client can sock it into the set. LERP, love, 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 love. This is like building your own bank. A lot of people who complain about this, like I had a client saying, "Oh, I don't know, I don't like life." You have to. This is a life insurance. This is not an investment. And if you're properly explaining this to the client and they get it, this is a huge, huge strategy. Okay. And a lot of them don't understand that you're not going to get the savings today. This is a tax advantaged product. Okay. The savings is later in life. And so this is one that you want to partner with a great person who understands insurance and how it works. And alternative, so this is really complicated stuff. So when you have your high net worth people, we want accredited investors. They are more sophisticated. Listen, the deferred 401k, the Roth, backdoor, some of those strategies are too simple for them. They that's not going to help them anymore. Oil and gas investments are what they need. So these are investment strategies, better places to put your money than socking it all away at the IRS in estimated payments. Sometimes you don't have to pay more estimated payments because people don't realize you're still paying the IRS. It's either before or after. Let's get the strategy in place that's going to kick in beautiful deductions or beautiful credits. The minimum on some of these, if your client has cash flow 25K, and you explain to them how these strategies work, you have a great subject matter expert here. TaxPlanIQ preferred partner is Vistia. Plenty of us have other professionals we work with, so you need to be able to understand how these work, get on the meeting with these people, know what they're talking about, but because the client trusts you, you're the person that has to pass the trust on to the subject matter expert. Solar credits. This is not putting solar panels on your house. This is investing in solar projects, like on a restaurant, a church, a school, and you're putting up money to help them get this. And the credits are really beautiful. And some states will allow it as well. I won't go into all the details on it. Here's a list. This is what TaxPlanIQ looks like. A bunch of strategies. I'm telling you, there are a lot of strategies. You don't have to give the client all of them. Pick your package. I create packages for my clients. If they're simple, I keep giving them 3 or 4. If they're already $1 million generating, now you can raise your rates or whatever. You can use the ROI methodology as we just learned today. This is what the ROI looks like, and look at the total savings over 10 years, over $500,000 if they do what you tell them to do. When they belly ache, tell them, get on my calendar and get a tax plan. Or they come back the next year, they didn't buy the plan and say, well, I told you to do the tax plan. I have plenty of strategies for you. Close the deal. Why are we crying? Why are we? So next steps, go through the client list. This is your homework. Go through your client list, search for high tax debt, set up strategy meetings, get templates together, because this is what's going to make your plans go like this. You can do a tax plan in TaxPlanIQ in less than 1 hour. I know because I did it. Okay. And then you make your first video, social post. All these things are going to get the pipeline open, that you're going to be mad at me because you have so much work to do, that you're going to be sick. Okay. I think that's it. That's my last slide. Woohoo.
Way to go, Angie. Great stuff. You got through it all. There's a lot in that. So thank you.